Take two. This is your boy Marty Ben here to introduce this episode of Tales from the Crypt. I have the immense pleasure of sitting down with Lyn Alden, founder of the Lyn Alden Investment Strategy. We just discussed a lot of things. An article she wrote last week or the week before dove into the Triffin Dilemma and the situation the U.S. finds itself in as it has stretched out its influence across the world using the U.S. dollar system as a weapon or a tool to gain dominance. We talked about the Triffin Dilemma, how QE may not have the robust effect on inequality that many people think. It certainly does have an effect, but there are other variables at play here, and we dive into that. We also dive into Lyn's decision to invest in Bitcoin earlier this year and why she felt comfortable this time around compared to 2017 when she first wrote about Bitcoin for her investors. So I think you guys are really going to like this episode. Incredible conversation. Covered a lot of topics. I hope you guys enjoy. This episode is brought to you by our good friends at the motherfucking Cash App. You should know all about them, but if you don't know all about them, let me tell you about them. Cash App is the easiest place to stack sats. They're helping you stack sats, send sats, receive sats, sell sats, if you so please. And on top of that, they're making sats the standard. We're not stacking fractions of Bitcoins anymore. We're big boys and girls. We're stacking whole sats. Whole sats. Thousands, tens of thousands, hundreds of thousands, millions, tens of millions, potentially 100 millions at a time. If you're big swinging dick out there, Cash App is making this extremely easy. On top of that, they're letting you stack slivers of stonks. I know you freaks don't love stonks out there, but I know there are some of you out there who are stonk curious. And if you are stonk curious, and your favorite stonk's a little too expensive, Cash App Investing is letting you invest as little as $1. Again, you can stack a sliver of a stonk. It is possible. Cash App Investing is a member SIPC and subsidiary Square. Because all of this is connected to your bank account, you can start stacking in stonks, slivers of stonks, or sats today. There's no 4 to 5 day waiting period. Cash App may even be your bank account. They're giving out account numbers and routing numbers. You can direct deposit your paychecks into the Cash App now. Big boy shit. Big boy shit. See those Q2 numbers for Bitcoin volume? Big boy shit. All right, go download the Cash App. And when you do, make sure you use the code STACKINGSATS. That's STACKINGSATS. You're going to get $10, and $10 is going to go to our good friends at Owls Lacrosse. That's Owls Lacrosse. Woo! 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 It's Owls Lacrosse. Enjoy this episode. Enjoy your life. You only got one. Okay.
You've had a dynamic where money's become freer than free.
If you talk about a Fed just gone nuts, all the central banks going nuts.
So it's all acting like safe haven.
I believe that in a world where central bankers are tripping over themselves to devalue their currency, Bitcoin wins. In the world of fiat currencies, Bitcoin is the victor.
I mean, that's part of the bull case for Bitcoin.
If you're not paying attention, you probably should be.
What is up, freaks? Welcome back to Tales from the Crypt. It's your boy Marty Bent here on a windy afternoon after the hurricane. The storm has passed through South Jersey. Little damage. I'm sitting down with Lyn Alden, founder of the Lyn Alden Investment Strategy, and as I understand, you were affected by the storm as well.
Yeah, thanks for having me. And yeah, we lost power, and it's just funny to find out just a couple minutes ago that we live like an hour from each other. So we're right in the same area. And yeah, the storms have just knocked out power in some areas more than others, and it's just it's kind of been a hectic week.
Yeah, it's early hurricane season. I wasn't expecting one at the beginning of August.
Yeah.
While we're on the beginning of August, you wrote a piece on August 2nd that I thoroughly enjoyed. The big tax shift, and as always. Chatting with you before we hit record, there were a couple of points in the piece that sort of challenged my beliefs, particularly around QE and how it affects inequality. And that's what I really loved about this piece, particularly, is that you dive into the different variables that may be contributing to that and the different themes that may contribute to the inequality in the U.S., particularly around U.S. dollar status as the reserve currency of the world, and how that's affected inequality and wealth distribution in the States. So I'd love to just walk through this piece, what sort of drove you to write it, and the conclusions that you came to.
Yeah, I'd be happy to. It was definitely a kind of a fun piece to write because it touched on so many different things, and it was kind of a challenge tying the themes together.
Yeah, and so let's just the one again point that really challenged my beliefs that QE drives inequality. What might, to an extent, you sort of point out in this piece that countries like Japan and not a country but an economy like the Eurozone have far greater QE but less inequality. So there's definitely some more variables, and I think to begin this conversation talking about the shift from a U.S. as a manufacturing and industrial country to a service-based economy that's got investments in foreign governments or countries and stuff like that.
Yeah, with anything as complex as wealth inequality, always has multiple variables involved. So one of the aspects of the article touched on the fact that, there's this kind of common view, which makes a lot of sense on the surface, that the more QE a country does, the more that leads to wealth inequality. And of course, the logic for that is pretty sound, right? Because as they, print money to buy assets, most of that kind of created wealth gets up into financial asset prices. So those that own the assets, which is a minority of people, end up, getting disproportionate benefits from QE. So the kind of the logical assumption is the more QE that a country does, the more wealth inequality we'd have from that effect. But one thing that's interesting is that the numbers kind of show the opposite, or at least show that there's not a very strong correlation, in the sense that Japan, for example, has done more QE as a percentage of their GDP than pretty much any other country. Like, so their Bank of Japan's balance sheet is over 100% of Japan's GDP. They've been doing it longer and at a larger magnitude than pretty much any other country. And they actually have among the lowest levels of wealth inequality. And of course, there are a variety of factors for there. It's not a very diverse country. It's kind of a very unified country. It's a very not one of those politically polarized countries. They have very inexpensive healthcare, for example, as on a per capita basis, despite the fact that they're the oldest country. You'd expect them to have very high healthcare costs. So they do a lot of things kind of fiscally and just culturally that kind of don't lead to a lot of wealth concentration, despite the fact that they've done a lot of this QE. And then you look at, say, the Eurozone, and they've done more QE than the US has as a percentage of GDP, but not as much as Japan, not even close to Japan. And they're, of course, that's a block of multiple countries. So some of the countries there have, more wealth concentration than others. But on average, it's somewhere between the US and Japan, where they generally have a little bit more wealth concentration than Japan, but not as much as the US for most of the countries. And then when you go to the US, we've done, we're catching up quickly here in 2020 with some of the most rapid QE around. But if you look back, since inception, we've done less QE as a percentage of GDP. If you look at, say, the Fed's balance sheet as a percentage of US GDP, than Europe or Japan, and yet we have far more wealth inequality. So it kind of points to the notion that there's definitely more factors involved for a country's wealth concentration than just their amount of QE they've done. And there's factors like demographics, there's different sort of tax and fiscal policies, there's geopolitical things like currency reserve status, and all those things can kind of feed into the equation that they can kind of have more wealth concentration or less wealth concentration.
Yeah, and let's focus in on the reserve currency status aspect of this, and the Triffin Dilemma, and this sort of hollowing out again of the manufacturing base here in the United States over the last X decades, and really moving our supply chains across the world. And this is highlighted in inefficiency, or probably a weak spot in America with this coronavirus. A lot of our supply chains are in places that are not advantageous for us at this current moment in time. And so that race to be the reserve currency of the world, while it certainly has its advantages, is proving in the long term to have some disadvantages as well.
Yeah, so if you look back over, say, the past 100 years of U.S. wealth concentration, it reached a peak level in like the late 1920s, and it started to decrease for a while. And then around the 1960s, 1970s, it started to find a bottom. And then ever since then, we've been in this period of rising wealth inequality. The past like 50 years or so. And one of the main things that happened during that whole period was the shift in kind of global monetary policy rather than just anything U.S. specific. So starting, prior to then, there's like, the Bretton Woods system. But then in 1971, of course, we went off the gold standard. And in the 1970s, they established the situation that we currently have today, even 50 years later, which is that the dollar is essentially the global reserve asset for most of the world, and all commodities around the world pretty much are priced in dollars. So even if France buys oil from Saudi Arabia, it's in dollars. It's not in either of their currencies. It's in dollars, and that holds true for most of the world. Most types of commodities are priced in dollars, and that made sense for a while because after World War II and then into the 60s, 70s, 80s, the U.S. was such a large portion of the global economy, and we were by far the largest commodity importer. So we kind of had this system where we run persistent trade deficits. We get lots of dollars out there, and there's so much demand for the dollar because it's the global reserve currency. You need it to buy oil, you need it to buy other commodities, and that kind of gives us a situation where the dollar is kind of always perpetually overvalued based on kind of what it would be if we didn't have this status. So currencies usually find a natural equilibrium around trade. So if you run persistent trade deficits, usually you have some sort of correction in your currency, and your currency weakens, and that reduces your importing power and increases your export competitiveness. But because there's so much external demand for the dollar, we never really normalize. We never really kind of go back to that equilibrium, and instead we run pretty consistent trade deficits, and that gets that's important for a global reserve currency to do, because a global reserve currency only works when there's enough of those currency units out in the world. But that has effects over the long term, right? So running persistent trade deficits doesn't come for free. And so basically, in exchange for having all the benefits of the global reserve currency, like, it increases our kind of military power, it kind of, it gives us a very strong standing in the world. It makes it so we can print money to buy commodities. It's a very powerful force. But on the other hand, we've had to basically export our manufacturing and industrial base to do this, because it made our physical products a lot less competitive than many countries, not just emerging markets, but even compared to Europe and Japan, for example. Their competitiveness in terms of physical exports is much better than ours. And so, we've had this cost where we've had to shift out a lot of this manufacturing capability, and that's of course disproportionately benefited working class people, blue collar workers that used to have kind of more kind of power in that arrangement. And now, because we've exported so much, that's been one of the contributors for wealth inequality over this period.
Yeah, we're seeing how much that's exacerbated right now with the economic shutdowns, and you point this out in the article, is that they basically run on a service economy. A lot of people depend on low-level jobs in the service industry, restaurant industry, travel industry, and it's really coming to a head at this particular moment, as many of these people, even when they are working, only work for tips or mainly work for tips or other sorts of vig on top of their low base pay. And so this has been a theme on this podcast for a while. It feels like America's in a very vulnerable situation right now, and its lust for the dollar reserve status may be coming back to bite us in the ass. And so that's interesting, and it's interesting seeing play out in the markets right now. I read about this yesterday. Like, are we starting to see in inflation, the beginnings of an inflationary event? You're seeing you mentioned that the dollar's had this equilibrium over time, but last 3 months the Dixie index is down like over 7% now. You see stocks up 20%, Bitcoin up 20-30%, gold same thing. Do you think we're beginning to see confidence waning in that reserve status?
Potentially. I view it there's a couple different ways to kind of look at it, right? So I shifted more to being dollar bearish back in the beginning of October 2019. And that's it basically happened because we had that repo spike, which, for people that don't know, basically the overnight lending rate, between banks, blew up, right? So instead of being able to borrow at a very low rate, suddenly that liquidity dried up, and the rate tripled or quadrupled overnight. The Federal Reserve came in the next day and had to basically print money to fix that hole. And then that marked a shift where the Federal Reserve had to begin buying treasuries outright. And so a lot of that was because, prior to then, the U.S. was relying on private buyers and to some extent foreign buyers purchasing its treasury issuance. So we had really rising treasury issuance, but we were kind of saturating the amount of available buyers. And so during the repo spike, bank cash levels got down to their low point over the past, ever since the global financial crisis. Banks had pretty low cash levels. They kind of decreased from their peak in 2014 because they were buying treasuries, and in 2019, right at the week of the repo spike, they hit their lowest cash level, for that decade, pretty much. And so basically, the Federal Reserve had to become the primary buyer of treasuries. They couldn't let banks continue to draw down their cash to buy treasuries. And in my view, that marked a pretty big shift in policy. So if we look back over the past, since 1971, the dollar's had these three big super cycles, right? So after 1971, it had this period of weakness. And then, after Paul Volcker raised interest rates, we had a very strong dollar spike into the mid 80s. And they used the Plaza Accord to weaken the dollar because it was hurting both the U.S. and other countries. It was just nobody's in interest to have a dollar that was just rapidly spiking like that. And then decreased, and then it had another like big increase in the late 90s and early 2000s. And then the shifting monetary and fiscal policies again, that kind of had another weakening event. And then ever since 2015, we've been in another strong dollar environment. So it's the third kind of major cycle in this kind of 50-year kind of policy that we're in. And so my view is that starting in around late 2019 or so, we're potentially kind of ending this current dollar cycle strength. And of course, COVID came along and it diminished trade. So we had kind of that temporarily strong dollar, right? Because that tends to happen in these big liquidity events, because so much countries have dollar denominated debt. They need dollars to service that debt. So when trade diminishes, we kind of have a scramble for dollars. We tend to get a dollar spike. So there's a couple ways to look at what's happening now to the dollar. So one is you could focus on the reserve currency status diminishing. That's definitely one lens to look through it. And I think that's a pretty valid lens. Especially because even though the dollar still has a large status in the world, we're seeing kind of cracks in it. So for example, over the past 5 years or so, central banks have bought more gold than treasuries as kind of a store of value, as a way to protect their currencies if they need it. We also have seen some of the more adversarial nations de-dollarize to some extent. So Russia, for example, has rapidly de-dollarized. And we're also seeing, for example, trade between Russia and China is rapidly de-dollarizing, and China is taking steps to try to de-dollarize, although they haven't done so as much as, say, Russia has. And so they use, between them, for example, they use more rubles, yuan, and euros than they used to compared to even 2 years ago. They've been rapidly kind of reducing their reliance on U.S. dollar status. Another way to look at it is that the U.S. can have these big bear cycles, right? So after the 1980s and after the early 2000s, the dollar fell pretty dramatically compared to a basket of foreign currencies, but it didn't really lose status, right? It was still the global reserve currency. It just happened to be, because of the shifting monetary policies, it ended up being a much weaker for a period of time. So just because the dollar goes down substantially doesn't mean that the end of the reserve status is right around the corner, but especially because we're also seeing in this cycle some things we haven't seen in those other dollar bear cycles, which is interesting. So for example, throughout that whole 50-year period, for the most part, the U.S. was the largest importer of commodities, but now the largest importer of commodities is China, for example. So it's in my view, the current system is really straining the dollar's role, and over the long term, these trade deficits are really built up. So we have, for example, a much deteriorated net international investment position. And this was actually predicted back, when this whole thing was constructed decades ago. There were economists that saw that this would eventually happen. Like they pointed out that in order to have the global reserve currency status and all the benefits, you have to basically export your industrial base. And so economists Triffin and Keynes both noticed that, and they proposed alternative things you can do, like a bank or other sort of neutral assets that could be used for kind of settling global trade. But because they stuck with the dollar, we had benefits for a while, but now we're kind of on the opposite side of that, where we are getting more drawbacks, and we might be seeing some cracks in the kind of usefulness of the current system, both for the U.S. and for the rest of the world.
Yeah, I think this is playing out with the civil unrest that we have going on right now. It feels like people have definitely been driven to a brink, if you will, and You mentioned this in the article. Maybe we have reached the end of a pendulum swing, and it may be swinging back now. And you looked at stock prices and how far away they are from their historical PE levels, and how much overvalued they are at this given point in time, and it may be people just seeking to keep up with inflation of the dollar, or with the printing in tech stocks and in the service economy.
Yeah, so an interesting thing to look at is that whenever we have these big dollar spikes, something breaks in the world. Usually multiple things break. So for example, when the dollar spiked in the 1980s, a lot of Latin American countries broke, right? Because they had large dollar denominated debts. And when the dollar goes up in value, it basically means that in local currency terms for them, their debts increase dramatically. It's like having quantitative tightening during a recession. So many of them couldn't pay back their debts, and then they default, or they have big, kind of inflationary currency crises. And so they had a lot of issues in the 1980s. Then when we had the big dollar spike in the late 90s, the same thing kind of happened to a lot of South Asian countries. So of course, Thailand, Malaysia, Korea, and then even Russia in the north, they all had kind of these big because they had very low reserves, a lot of dollar-denominated debts, and so that kind of broke their system. And then lately, in this current third dollar spike, we've seen Argentina break, we've had Turkey break, we've had Lebanon break, and then a lot of just kind of pressure. So we've seen like Chile have some pressure. They haven't broken to the same extent, but they've definitely had some issues because they have a lot of dollar-denominated debt. But also we see that whenever we have these strong dollar periods, the U.S. itself also, corporate profit growth tends to flatline for several years whenever we have these strong dollar environments. And because, a lot of the globe's so interconnected, right? So when the dollar strengthens, it makes our exports less competitive, and it makes our kind of trade partners slow down economically. And so that often gets relieved by a much weaker dollar when they have to end up shifting monetary policy. And so the current situation now also is just because there's the US's role, their percentage of global GDP that the US kind of makes up is diminished over decades, right? Because the rest of the world's kind of caught up with us compared to where we were, say, after World War II as a kind of a dominant economic power. So trying to use one country's currency for the entire world trade is much harder to do when that country is a diminishing share of global GDP. It's easier to do when your country is like 40% of global GDP, but it's harder to do when that country is only 20% of global GDP. And I think we're kind of running into some of these kind of boundaries here.
Yeah, I would agree. And it drives a very interesting thought in my mind. Is we talk about it a lot, is that the U.S. government and the Treasury and the economy has sort of weaponized the U.S. dollar against other parts of the world and financial system. If it is hitting ahead, like, what is the next stage? Like, trying to project forward, like, what does the world look like with? I mean, it has had it before on the gold standard, but what would a transition to like an apolitical currency like gold or Bitcoin? How would that change the dynamic of global trade and the inequality of the world? It seems that it would create a lot less friction, in my mind at least.
Yeah, there are a couple different options to go down. So, people often ask, okay, if it's not going to be the dollar, what's going to take its place, right? But that starts with the assumption that there has to be one country's currency that is the global reserve currency. And this is actually, this period where the dollar has had the status is actually very unusual, because even though in the past there have been, quote, global reserve currencies, they've never had this far of a reach. So for example, there was never a time where like only the British pound was used worldwide to buy all commodities. That was never part of that particular era's status as the global reserve currency. So this kind of current run from the 1970s to the present, where all currencies are fiat currencies, but only one of those currencies can be used to buy commodities anywhere in the world, is historically unusual. We have kind of a global lock. And we've been chipping away at that. So for example, on margin, China's been able to buy, some energy, kind of outside of the dollar system. And, just trade between like Iran and certain other countries have kind of skirted that a little bit. And of course, more trade between China and Russia, so we're kind of seeing cracks in that system. So there's basically, instead of one country coming along and just we use that currency for all commodity pricing, that's not a realistic kind of way to look at it, even though a lot of people look at it that way. So no country now is kind of big enough to have a share of GDP to have their currency be the only currency used for like global commodity pricing. And that's kind of the key foundation of what the global reserve currency is kind of the shared unit of account for commodity pricing. So there's a couple ways that the system could transition to. One is simply a more multipolar currency world, right? So if the European Union, the Eurozone can buy more of their energy in euros, for example, that diminishes their reliance on the dollar. And if we see China be able to increase their contracts to be able to buy energy outside the dollar system as well by using their own currency, that can kind of make a more multipolar world for at least for the medium of exchange portion of these global reserve status. So instead of just one country kind of having that benefit, there'd be 3, 4, or 5 currencies that are kind of like currencies that can buy commodities generally. So that's one option, is kind of this more multipolar system. And in that environment, there's a variety of kind of neutral reserve assets they can use. So one option is, of course, gold. Most central banks do hold gold. Many of them haven't been buying, but other ones have been buying. We've actually had more gold buying by central banks in the past 2 years than pretty much any other year over the past 50. So we have kind of seen an increase in gold buying, especially among some of these countries like Russia that have been trying to de-dollarize. They've been kind of shifting towards that more neutral, kind of inherently kind of inflation-adjusted asset with no counterparty risk. So that's one option. An option that really hasn't gained much traction is, so as I mentioned before, there were economists that saw this issue, right? So Triffin saw this issue, Keynes saw this issue like decades ago when this was all starting, and they proposed that instead of a global dollar status, to have something like a Bancor or an SDR, and all that is a basket of the major currencies. So the modern version of that would be a Libra if Facebook pulls that off. So basically, the International Monetary Fund can issue SDRs, which are just baskets of global reserve currency. So you have like the dollars in there, the pounds in there, the Swiss francs in there. It's kind of a collection of some of these major currencies. And what that does is essentially it's kind of a multipolar currency world, but it's kind of packaged together. So of course the older format is just issued by the IMF. You could also put it in a stable coin format. So all these, there's different kind of technological approaches to package them together. But the downside is it requires a lot of working together. So for example, all of those countries have to agree to print some dollars, print their currency, put it into this package, right? So the IMF can't just do it on its own. It can't just create those currency units on its own. It pretty much just packages them together. So that's been kind of we haven't really seen the SDR really take off, despite the fact that it's existed for decades. That idea is just kind of not have ground. And then we have Bitcoin. A lot of people are excited about Bitcoin's potential role in this. So it could, for example, serve as, a diversification if central banks, in addition to their gold holdings, if they want a kind of another asset that doesn't have counterparty risk, that's inherently scarce and arguably inflation adjusted because of its scarcity. And so there are like a variety of different ways that this can shift to, but they all involve kind of less reliance on any one country's fiat currency.
Yeah, and so obviously I'm partial towards Bitcoin. This is a Bitcoin podcast, and one thing that really excites me about Bitcoin, and going back to energy markets, is I believe that's where the basis of most of this trade starts. The commodities, particularly energy, oil being the biggest, obviously, and Bitcoin with proof of work mining particularly really gets to the base level of pricing those commodities, especially the wasted energy. So I alluded to it in the email I sent when we were setting up this podcast, but I work for a company, Great American Mining, and we're basically on oil and gas fields here in the US, and we're using their waste gas to mine Bitcoin. And so they're able to find a price, if you will, for gas that would otherwise been wasted. And when you apply that to the rest of the world, whether it be stranded renewables, waste gas, or just extra energy that's being produced on certain oil fields or wherever it may be, it just inherently makes sense to me that Bitcoin may be the best sort of medium exchange pricing mechanism for a world that that doesn't want to have to play nice with each other. It could be a currency of enemies, if you will, and you don't have to worry about constructing an SDR or trying to replace the U.S. dollar reserve currency with some other country's currency. And to me, it makes sense that we would transition to that. Sorry, I'm rambling here. Just want to get those thoughts out there.
Yeah, it's definitely an efficient way to do it. Especially if it continues to gain market capitalization. So right now, Bitcoin is still a pretty small market, which is actually one of the kind of the bullish arguments among Bitcoiners, is that this has a lot of room to grow. So of course, if you own a share of it and they're not really making much more, then each individual Bitcoin can go up pretty dramatically. But you know, even gold has limitations, right? Because how often are these like gold reserves audited, right, on different central bank balance sheets? If they have to kind of settle in gold, that kind of creates like a logistics headache. If they want to have kind of an underlying settlement layer for it. Bitcoin is, of course, it's very efficient, it's very liquid, it's easily transmissible, and so they have a kind of a fast way to verify transactions if they want to go that route for kind of using that as like a settlement asset. And to your point, places that have had kind of very cheap electricity or very cheap energy can have often been able to export that in certain ways. So, for example, I believe it's Iceland that kind of focused heavily on aluminum processing, because that's a very electricity intense industry, and being able to take that extra energy, convert it to electricity, and then you basically are exporting your electricity in the form of aluminum, right? So Bitcoin plays a similar role for kind of finding these spots in the world that have very cheap energy, stranded energy, or overbuilt like hydroelectric dams, things like that, where just energy is being produced but not used. And that's kind of a way of exporting that electricity as a form of value, because you can store up this asset. And kind of it's a gold deposits, for example, they're pretty widespread, but they're still only in kind of the big ones are in a handful of countries, whereas Bitcoin's something that anywhere that has kind of cheap power can go into and kind of use that to their advantage.
Yeah, it's revolutionary, I think, and it's going to be fascinating to watch play out. Right now, a lot of the mining is in China off of hydroelectric, but I think we're going to see a huge shift as oil and gas producers, particularly here in North America, as the United States, going back to like Triffin Dilemma and trying to become trend towards more self-sufficiency, particularly energy efficient self-sufficiency. This provides a alternative revenue stream for these producers who we've seen this year get blown out due to potentially a terrible misallocation of capital in the space, because they just want to get the oil out of the ground and get it to market, and that's the best way to monetize that. But now with alternative revenue streams, you could probably have better capital allocations in that sector particularly, and it can help sort of shore up our independence from an energy perspective.
Yeah, I think so, especially from their perspective. Yeah, if they were using their energy, the fact that instead of selling their energy on the cheap, if they were to use it for something like Bitcoin mining, that would have helped their bottom line.
Yeah, and that's our main thesis at Great American Mining, is that these oil companies are going to wake up to that, and it's going to drive. There's going to be positive externalities throughout a lot of the supply chain that people don't really realize yet, and it is still early days though, and it's another fascinating article that you wrote a few weeks ago is why you decided to invest in Bitcoin earlier this year in April, I believe, and I really enjoyed your perspective of why you didn't get in 2017. Obviously, the price was inflated, but you were also cautious about the network effect of Bitcoin and the competing currencies, and so I'd love to dive into how your perspective shifted on that over the last 3 years. So has Bitcoin sort of cemented itself in your mind as a mainstay?
In my view, it has. So yeah, when I originally covered Bitcoin in autumn of 2017, because we had that big run up in price, and I had a lot of my readers kind of email me and say, hey, what do you think of Bitcoin and other cryptocurrencies? So I did that big kind of long form deep dive article into it. And I approached Bitcoin from a couple different angles because, especially back then, the narrative, they were still kind of emphasizing the medium of exchange aspect of it, in addition to the store of value aspect of it. So it's kind of like approaching it, its valuation from a couple different perspectives, revolving around medium of exchange and store of value. And so I concluded that as medium of exchange, it looked very pricey, but as a store of value, it definitely had some promise. And my main concern at the time was that even though Bitcoin is scarce, anyone now, because it's been figured out how to do it, anyone can create a cryptocurrency. And then those have their own kind of scarce units. So you could have a situation where the whole market gets very diluted, where there's just like, countless cryptocurrencies and none of them really have a ton of market share. So it's kind of like, none of their network effects are very strong, and we don't really have a lot of value kind of coalesce into one or two of the protocols. Especially because 2019 saw like that huge alt season, and Bitcoin fell below like 40% of market capitalization of the crypto space. So I covered that, and I said, I'm kind of just gonna, wait and see here. I didn't take a position. And so of course we saw that blow off top at the end of the year, and then we saw a big crash, and we've had this kind of consolidation pattern. So I've kind of reinvestigated the market early this year in March and April, and I saw that kind of during that big liquidity crash we had in March, right? So when we had the whole COVID shutdown, we had liquidity dry up, we had the dollar spike, we had even stocks crashed. Even treasury market became illiquid, gold and silver sold off, and then Bitcoin was influenced by that as well. It had that big sharp price drop because it's almost any asset other than like hard cash and like T-bills crashed in mid-March. And so I just noticed it bounced back pretty hard. And Bitcoin has, compared to 2017, it's increased its market share, especially if you look at kind of you can look at just pure market capitalization, but you can also do other things, like you can take out stable coins, you can take out highly centralized currencies, and just see as among currencies that are trying to be like money, it's got even bigger market share, right? So it's kind of showing that over 11 years into its history, it's got very strong network effects. I also see that every single time I look at the industry, the ecosystem's getting easier to use for all the different access points. I looked at it back in 2011. It was like it's like the challenge of even getting into the space was very hard. And then I looked at it in 2017. It was way better. And I looked at it in 2020, and I'm like, it's getting so much better so quickly. So there's gonna be this kind of the on ramps for both retail investors and institutional investors keeps improving. I also liked seeing that there were kind of Bitcoin specific companies. So instead of just companies that only focus on all cryptos, there have been more kind of Bitcoin specific. So there's companies that you just. Sorry about that.
All good. All
My
good.
internet got cut off. I don't know what the last thing you heard.
The another thing that really drew your attention to Bitcoin specifically were the sprouting of Bitcoin only focused businesses.
Yeah. So over the past while now, we've seen kind of instead of just companies that focus on cryptocurrency in general, we're seeing, in my view, more companies that kind of focus on Bitcoin specifically. And I think that that's kind of a valuable part of the protocol's network effect, to have kind of companies built specifically around that protocol, rather than being able to kind of easily switch among all the different protocols. So I think over time, Bitcoin's network effect, specifically as a store of value and as like a settlement medium of exchange, has really kind of enhanced over time.
Yeah. And it's going to be interesting to see if we rip into another bull market here, how much more of a network effect and dominance it accrues. And just yesterday, it was highlighted that a publicly traded company is going to start diversifying their cash balances into Bitcoin too. And that's another trend I'm very interested to start following more intently, is how do corporations, beyond individuals, now we have corporations starting to pay attention to what the Fed's doing and the relative strength of the dollar to years past, and thinking about diversifying away from that into things like gold and Bitcoin. And I think once you see a crowd of boardrooms sort of asking the companies that of the boards they sit on to start investing in Bitcoin, there's going to be some pretty big dominoes to fall, and it'll be interesting to see how much sort of dominance Bitcoin gains in that scenario.
Yeah, historically, it's I often like to emphasize long-term debt cycle, where debt kind of builds up over different cycles, multiple cycles in a row, until it gets to such a high level that it usually requires a bigger deleveraging event. So we often see these issues where so much debt builds up in a system, and instead of having some sort of sovereign default, there's kind of a soft default in terms of a currency devaluation. And if you look back, for example, after World War II, which was the only other time that federal debt to GDP got this high, the next several years, like several decades, I mean, were pretty much bad times to hold cash or treasuries. Like yields did not keep up with inflation for a multi-decade period between, like, if you bought treasuries in the late 1930s all the way to the mid 1970s, you didn't really make any money. You just kind of lost value by holding, T-bills, 10-year treasuries, and just keeping your money in bank accounts. It just kind of wasn't worth it. And we're kind of at that part again where real yields are likely to be, low for a very long period of time, and most likely negative for a big chunk of that time, meaning that the yields you get on, T-bills, treasuries, or bank accounts fail to keep up with inflation. So whether you're an individual or you're one of those companies that has billions of dollars in cash equivalents, right? It kind of gives an incentive to try to park some of that in something that kind of holds its value a little bit better. So, for many people that can be gold or silver, and then but Bitcoin scales very well, especially if its market cap keeps increasing. In this halving cycle, the next halving cycle, there's kind of more incentive to try to hold some of that value in something that is scarce, because the whole kind of the opportunity cost of holding a yieldless asset is it, during environments where treasuries and T-bills and bank accounts give you a positive real rate of return on your money, it can make sense to hold them. But when you're not even getting your yields are not even keeping up with inflation, there's very little incentive to hold all of that kind of this fiat store of value.
Yeah, I agree. This is another thing you alluded to in the article we started talking about in the beginning of this podcast, is the real rate of return on stocks in the future. Like, they may, and that's, I think, something that the layman doesn't really understand. They see stock markets rallying, they're like, oh, we're getting wealthier. But when you factor in inflation, the real rate is not as pretty as it may seem, especially if you price stock indices and things like hard assets like gold.
Yeah, so there's a couple ways to look at that. So in any given decade, uh, an equity market in the world does pretty well. So for example, the 1980s, Japan's equity market did very well. In the 90s, the US did very well. In the 2000s, emerging markets did very well. In the 2010s, the US has done very well again. And those decades usually end with that market that did very well becomes quite overvalued. So, for example, in the late 1980s, of course, Japan had one of the biggest equity bubbles ever seen. In the end of the 90s, the U.S. had the dot-com bubble. At the end of the 2000s, emerging markets, many of them were priced as high as the dot-com bubble was for the U.S., like in terms of, say, the cyclically adjusted price to earnings ratio. Like India and China, they had just very expensive markets. And then now we're in an environment where the U.S., as the kind of 2010s decade came to an end, we're now in 2020, of course, we have pretty high valuations by just about any metric, both compared to our history and compared to a lot of comparable countries in the rest of the world. And so the way that tends to kind of work out is that the next decade usually isn't very great for that equity market, especially in real terms, right? So even if you have nominal returns are okay, it often has these long periods where, as priced in a hard asset, like say you look at the S&P 500 as priced in gold, it actually peaked back in 2018, and we've been making lower lows and lower highs in the S&P 500 as priced in gold since that period, even though it's of course making new nominal highs since then. And so I doubt that the U.S. Kind of indices, equity indices, are going to be really kind of good real return generators over the next decade, regardless of what they do nominally. And I think that investors are going to be looking for other assets that could potentially give them some alpha. And there's gold and silver that I've been bullish on. The thing about Bitcoin is that because it's still a small market capitalization, even a small allocation of Bitcoin can potentially do wonders for a portfolio if it has anywhere, if this halving cycle, the next halving cycle do pretty good price action for the protocol, you could see a lot of gain from even a smallish Bitcoin position, which is kind of the case for institutional investors to have at least some allocation, like to have a non-zero Bitcoin allocation.
Yeah, it's got that asymmetric payoff.
Yeah.
And but going back to like real returns, and it's something that really irks me is the fact that the Fed will come out and say that inflation is not hitting their target of 2%. But if you look in certain areas, it seems that there's pretty high inflation. So I'm very interested to get your thoughts on what do you think of the CPI? Like, is it a good measure of inflation? Like, the Fed came out a couple of weeks ago and they're starting to posture like they want to attempt to overshoot the 2% target and with their policy moving forward. And is that just going to exacerbate the inflation that isn't highlighted via the CPI?
Yeah, so I don't think it's a very good measure, especially, they've kind of changed how it works over the time. So there's all sorts of things they can do to get it down. So one is that they can use substitutions, and it also doesn't necessarily reflect the basket of goods that a normal person buys. So for example, this year, inflation for healthcare costs and food are about 5% year over year, right? So that's kind of, and if you're not making a lot of money, necessary expenses take up a bigger share of your income than if you're making a lot of money, right? So if these kind of necessary things are going up in price pretty rapidly, that can hurt a lot of people. So we've seen over this kind of quote low inflation period, we've seen kind of a big divergence between services and goods. So for example, things like education, things like healthcare, all sorts of stuff that we can't really outsource. A lot of that has gone up a lot faster than the official CPI. On the other hand, things that either greatly benefit from technology or that greatly benefit from offshoring, those are the things that have been more disinflationary. So for example, you can get a much better TV now than you could 10 years ago for less money, right? So the inflation of TVs has been greatly negative due to a combination of better technology and outsourcing. But some of these trends can reverse. So for example, partly, after decades of Triffin Dilemma, forcing the U.S. to have, very, kind of wide trade deficits, now there's more of a political interest in getting some of these supply chains back. So COVID-19, for example, showed how vulnerable we were with medical supplies, right? So medical supplies, we mostly had to import them. Same thing with pharmaceutical components. We had to import most of that because we don't make it here. In addition, for example, Donald Trump made the trade deficit with China one of his kind of key policy goals, to try to just have kind of a less imbalance there and more kind of domestic production. And so going forward, if we have less kind of benefit from offshoring, that can take away one of the drivers that have offset some of these inflationary trends. So if we only look at, say, healthcare and food and education and services, all sorts of things like that, inflation would have been higher. So if we kind of diminish some of this goods disinflation, that can translate into higher inflation. And the Fed, they actually don't even look at CPI. They look at something different, which is PCE. So that even takes out like food and energy, for example. So
Nobody needs those.
yeah, so basically they kind of understate inflation, and then they want to overshoot their understated inflation. So I do think we could have an environment where, we're getting into the much higher inflation than kind of the very low levels we've been measuring in this particular, time. Because right now, of course, we had the impact from the pandemic and the shutdown. So we've had kind of very low inflation prints, right? So CPI is very low, PCE is very low. But of course, we're in kind of this brief deflationary shock. So for example, people made fewer big purchases. We had a lot of shutdowns. And so even though we had kind of essential goods inflating, we had kind of a disinflation among, discretionary goods. But as kind of the economy normalizes and there's a lot more money supply in the system now, I do think we could see kind of a stabilization or an uptick in velocity. We could see higher inflation. And some parts of the treasury market are already kind of sniffing that out. So in addition to gold and silver and Bitcoin all doing well, if you look at treasury break-evens, right? So the difference between treasury inflation protected securities and the normal type that are not inflation protected, we've seen a lot of buying interest in the inflation protected type. So we've seen kind of the market's expectation of inflation rising ever since it bottomed in March.
Yeah, and so that's one thing I've been wondering too, and thinking about and writing about isn't this a similar situation at the Weimar Republic? I'm not saying we're going to have hyperinflation here, but the Weimar Republic was in a very similar situation, similar in the fact that they shut down their economy when France invaded them and told their factory workers not to go to work and we'll print money to pay you. it seems like we're doing something similar here, where it's like, hey, because of this virus, we're going to tell you not to go to work. We're going to bump up unemployment benefits and even airdrop some money on you. And I think the powers that be have not thought through the repercussions of that particular policy, especially if we extend it into the future and keep the economy shut down to a certain extent.
Yeah, there are a couple historical comparisons. So one thing I've been doing is contrasting this period with the Great Depression in the U.S. So for example, during the Great Depression, they didn't have like FDIC insurance, right? So when banks failed, you just lost your deposits. And so during like a 3-year period from 1929 to like 1932, about a third of U.S. broad money supply was just destroyed. It just went to money heaven. It just ceased to exist pretty much. And so
Money heaven.
you actually had outright deflation in the money supply. So that was a very strong deflationary environment, until about 1933 or so, when they started to reverse that, partially by the intentional dollar devaluation relative to gold and a lot of money printing. So if you look at this period, however, even though we've had a similar kind of economic shock, the government has done so much transfer payments, right? So just direct cash to businesses, to people, to corporations. We've seen a very sharp rise, like pretty much the highest ever modern increase in the money supply, even though we've had kind of a decrease in production. So in the near term, it's not been very inflationary because, as I mentioned, like velocity just collapsed. Like, so people aren't spending that money; they're just saving it. They're paying off debt. They're buying essentials. But as we kind of see things normalize, I do think that the increased money supply compared to the not increased amount of goods produced, and in some cases supply disruptions, could be more inflationary, especially in targeted areas. The Weimar Republic was interesting because if you look at hyperinflations throughout history, most hyperinflations occur to countries that have an external obligation that's not something they can print. So it happened in the Weimar Republic, with war reparations. After World War I, they owed war reparations, and that kind of is an obligation that they can't print. We see similar things in certain emerging markets over the decades, where if they have, for example, dollar-denominated debt, and so if we go back to the global, reserve status of the dollar, a lot of times the only kind of loans they can get at reasonable rates, either for the corporations or their governments, is to borrow in dollars. So when you have kind of a situation where the dollar increases and you have a recession in that country, those debts become unpayable, and they can't print those obligations away because those countries can't print dollars. So what we often see is a hyperinflation or a near hyperinflation in the currency, where you just see rapid deterioration in the currency strength. One of the advantages today among developed markets is that a lot of the obligations are denominated in their own currency. So for example, the US sovereign debt is denominated in dollars, and Japan's sovereign debt is denominated in yen, for example. So my base case isn't to see hyperinflations out of these major currencies, but I do expect to see kind of pretty considerable currency devaluations, probably similar to what we saw in the 1930s, for example.
And while we're on this subject, I'd be interested to get your thoughts on modern monetary theory. It seems like that's going to be, arguably it's already being implemented, but it seems that it's becoming more popular, especially among people of power who have the ability to implement it. How do you think that that affects all of this?
So if you look back in the 1940s, they used pretty much MMT to fund the war effort. So what that is kind of the combination of the Treasury and the Federal Reserve working together. So usually the central bank is supposed to be independent, or at least in the current system, that's kind of how it's supposed to work. But if you get to a situation where debt becomes very extreme and the government wants to do very large fiscal, they work together. So for example, the Federal Reserve bought a lot of the Treasury issuance that the Treasury issued in order to fund World War II. And so in that sort of environment, you get kind of a financial repression where you're in that environment where rates are held down to very low levels, despite the fact that you can get increases in inflation. So it ends up being kind of a currency devaluation environment. So for example, I just tweeted out, that the dollar officially just lost, it's 1% of what it was when we had that gold peg. So for example, the dollar used to be pegged to it was $1. It was 1 ounce of gold was equal to $20.67, and today we touched $2,067, right? So And Warren Moser of MMT fame replied and said, it's not about the value of the dollar, it's about the value of all dollars. And I think that kind of gives a good insight to how they view it. And so in this environment, we're going to have probably very rapid, very large fiscal spending combined with low rates and even yield curve control by the central bank to keep rates low. That tends to result in these currency devaluations that I've talked about. That usually these long-term debt cycles are resolved with some degree of currency devaluation. In a bad environment, it can be a hyperinflation, whereas in a more controlled environment, it's just kind of a partial devaluation, like we saw in the 1930s or like we saw in the 1970s, for example. So I do think we're going to be in a more MMT heavy environment, similar to the 1940s. But instead of fighting an external war, it'll be fighting, whatever else they want to fight, either the response from the pandemic or just the massive amount of debt in society. So I do think that this is going to be an environment where a lot of these scarce assets can do pretty well, like gold, silver, copper producers, just high quality scarce assets, and that, in my view, includes Bitcoin.
Yeah. So that's my consternation with all this policy, especially MMT is an extension and a amplification of the policies of the last decade and a half, I would argue, and it's just delaying the inevitable of this mass devaluation you're talking about. Like, what would it take for the Fed or even the U.S. government to sort of bite the bullet and swallow the hard medicine of trying to contract the balance sheet and or maybe put some more hard assets on their balance sheet or peg the dollar even to a hard asset like gold or Bitcoin. It seems that MMT and QE are just politically expedient solutions that we have been able to prove, I would argue, up to this point, aren't really effective in the long term.
Yeah, one kind of axiom to focus on for sovereign countries that print their own currency is that they very rarely default for sovereign debt. So, for example, a lot of the sovereign defaults you hear about, it's because it's those emerging markets, for example, that owe a lot of dollar-denominated debt, for example. Whereas you wouldn't really see, say, Japan default on yen-denominated bonds or the U.S. default on treasuries. So instead, what they do is they turn to soft default, which is devaluing the currency. And so they turn to things like QE and other ways where they print money to buy those treasuries with the hope of eventually inflating it away. One thing that's kind of different about 2020 compared to the past 10 to 15 years is that we've kind of shifted to some of that money getting more in the real economy, which can be more inflationary. So one of the frameworks I like to share is Ray Dalio's framework of Bridgewater, one of the world's largest hedge fund, and he kind of thinks of three different types of monetary policy. There's monetary policy one, which is the central bank can manipulate interest rates, and that kind of have different effects on the economy. Now, monetary policy two is that they can turn to QE or asset purchases, where they print money and they buy things like treasuries and mortgage-backed securities, and that doesn't really get money out into the economy. It just kind of recapitalizes banks and does things like that. So, for example, in 2008, most of that didn't really find its way into the economy, but it did kind of it recapitalized banks. So they went into that crisis with 3% cash as a percentage of assets, and they ended with 15% cash as a percentage of assets because the Federal Reserve printed money, gave them the money, and then took some of their assets. So monetary policy three, on the other hand, is direct injections of that cash into the economy with printed money. And so if you look at, say, transfer payments, right, by the government to its citizens and people, 2008 wasn't very big in that regard. They didn't actually give a lot of money to the people and to companies. It mostly just went to shoring up the banking system. So even though people feared that QE would be inflationary, it really wasn't for the most part because it just kind of found its way into financial markets. It didn't really get out into consumer prices. So you could argue it was inflationary for asset prices, but it wasn't really inflation. It wasn't really inflationary for, say, the cost of bread or something. Whereas what we're experiencing now is with such a large kind of fiscal injection into the economy, this is a somewhat more inflationary environment down the road, most likely, because they are putting money directly into the helicopter checks that people got, the $600 a week in extra federal unemployments people got, $500 billion went out in PPP loans to small businesses. Most of those turn into grants, so they don't really have to be repaid. They just become kind of free money. We've seen, kind of a backstop of the corporate debt market, right? So the Treasury allowed the Fed to buy corporate bonds and cover their losses. I think we're in an environment now where it is kind of fundamentally different in some ways in the last 10 to 15 years, in the sense that this time it could be more inflationary. And what they're probably going to do is that they can use yield curve control or other things to lock yields at pretty low levels, even if inflation gets higher than those levels. So you're in an environment where if you're holding money in a bank account or in treasuries, you can lose a lot of your purchasing power over the course of a decade by kind of keeping it in those negative real yield instruments.
Yeah. Do you find this insane like I do? Am I weird to find these solutions insane?
I think I would if I didn't see how many times in history the same thing happens. That's what's
exactly.
Funny. Yeah.
Well, that's the definition of insanity.
Yeah.
Right? Like they're repeating things that have happened many times.
Yeah. Like I shared with some of my subscribers. There's a book that was kind of going over some of the policies in ancient Greece, right? So like 2,600 years ago or something like that. And they had currency devaluations then too. Like they had the same problem. They had this big debt buildup. And so one of the things they did was they devalued the currency. It's literally a cycle is like as old as like modern history is that we find ourselves too much debt builds up and they either can choose like a big kind of nominal default and kind of just start fresh, or they can devalue the currency and kind of default in real terms. And it's a cycle that keeps happening over and over again. So a lot of people kind of focus on how unusual it is, and it always is unusual, but it's just funny how reliable it is. Like every 50 to 100 years, the same kind of things happen with, of course, different tools each time. So each time they have kind of different ways to do the same thing.
What if Bitcoin breaks the wheel? That's the question.
We'll see.
We shall see. And to tie this up, I know we're going over the allotted time here to bring it back to the original paper we started talking about in the Triffin Dilemma. So do you think a way to sort of help bridge the gap of inequality is is to bring more manufacturing home and try to produce, like it may be in the short term may hurt a little bit to produce things here, but in the long term it may create a more stable economy overall?
Yeah, I think so. I think running decades and decades of persistent trade deficits is not a permanently sustainable situation. And I think we're kind of testing the breaking points. So we've seen a rise in populism, for example, and that tends to happen at these culminations of these long-term debt cycles. And then especially when you add the element of that we've outsourced so many of the kind of manufacturing jobs. And people often think it's like an emerging market phenomenon, like you only outsource jobs to emerging markets. But for example, Japan and Germany have much larger industrial bases than the US does as a percentage of GDP, right? So it's not just like developed markets all outsourcing their job to emerging markets. It's more been a specific US thing. Like it's not something that a lot of our industrial advanced peers have done. And so there's clearly a renewed political interest in bringing some jobs back, but that's probably going to require a shift in kind of the way that the global reserve currency works, because you can't bring all those jobs back while still having the global reserve currency, at least as currently structured, like where it's the only currency that the whole world can buy commodities in, for example. That something has to change in some of the ways that we previously went over, either a kind of a more multipolar currency world or different sort of neutral like reserve settlement assets, rather than just kind of using the dollar as this kind of global lock on everything, because those are kind of competing forces, like trying to bring jobs back while also trying to enforce dollar status around the world are kind of competing interests.
Yeah, the reserve status is sort of like the ring from Lord of the Rings. It's got this, somebody's got to throw it in the volcano of Mordor.
Yeah.
Well, Lyn, I really love your content. I appreciate that you took some time to sit down and record this conversation. I thoroughly enjoyed it, and I think the audience is going to get a lot of value from your insights. And I guess just to wrap it up here, do you have any sort of parting notes, final thoughts on the state of the global macro situation right now, or anything we should look out content-wise from you in the future?
No problem. And thanks for having me. And I just think that 2020 is going to be a very interesting decade. And it's a general rule that whatever worked in the past decade is usually not the same thing that works in the next decade, right? So Of course, individuals like a smaller thing, of course, can. So, for example, even though Bitcoin worked in the past decade, I think it'll still work in this decade. But for example, the dominance of U.S. stocks over pretty much any other asset is unlikely to repeat as strongly in the 2020s. And so, I think investors would do well to kind of like look at first principles and see what things are likely to do well in this environment. And you can use kind of history as a guide, or you can use just math, just kind of looking at, okay, what does well in a negative real rate like world, right? So if we're in a long period of negative real rates for things, what sort of things do well? And generally the answer is scarce assets, especially if they're not kind of inherently overpriced, like say like Manhattan penthouses or something. Like as long as you're kind of focusing on reasonably priced scarce assets, they tend to do very well in this sort of environment. That's kind of my view to kind of focus on.
I align with that view. That's why we're into Bitcoin. That's why we talk about Bitcoin. And again, thank you, Lyn. I really appreciate it. I hope you have a great day, and hopefully we can do this again at some point.
Yeah, sounds good. Thanks.
Awesome. That's all we got this week, freaks. Peace and love. Take care.